Ron Insana agrees with Bob Dahl, but Euro Pacific Capital's Peter Schiff says while the Fed has put a floor on the market, there's no free lunch. Peter, we want to start with you. You disagree with Bob that it's a win-win situation and it's not a bubble. Why is that?
Well, first of all, if the Fed begins to taper, which I don't think it's going to do, we'll be back in recession. It's not going to be good for stocks. The whole rally is based on QE. That's why the Fed's going to keep the monetary spigots open, because they want to keep the phony recovery and they want to keep inflating these asset bubbles in the stock market and in the real estate market. But the problem for the market is the more the Fed succeeds in pushing up the market now with QE, the further it's going to fall once the QE stops, because it has to end eventually. Otherwise, the dollar is going to collapse, and it's not going to matter what your stock portfolio is worth, because you're not going to be able to buy anything.
But, Peter, isn't the whole point that the Fed says it won't step in and start doing that until the economy on a fundamental basis is better?
Well, but it will never get better fundamentally until they stop QE. QE is preventing the economy from fundamentally recovering from the damage. So the Fed is going to keep doing it. Again, it's like a drug. The QE keeps us high, but if we lose the drug, then we go through withdrawal. We're never going to have a genuine recovery until the Fed lets us have a real recession. So when they take away the QE, then we're going to go right back into recession. It's even going to be bigger than the one in 08 and 09 because a lot of damage has been done structurally to our economy because the Fed has interfered with the recovery with all the QE.
Ron, I'm sure you're itching to get in.
Well, first of all, I don't agree that QE is an artificial deflationary global environment. The Federal Reserve has been battling a war against deflation, not only domestically, but globally as well. In fact, there's an interesting chart I got today from Gold Bullion International that shows Eurozone inflation and the gold price. And as you can see, inflation rates in Europe are still falling. They are also still falling here in the United States. So the Fed is filling a hole. Letting a recession come through and bring prices of assets and other goods and services to market clearing levels was something that was tried in the 1930s with disastrous results. This isn't a bubble.
No, it wasn't.
Sure it was. I know, Peter, you and I disagree on history quite a bit, but the one thing I will say is...
you're ignoring history and you're rewriting it. And first of all, there is no war against deflation. They're trying to keep asset prices from coming down, but that's not deflation. The Fed is creating inflation. There is no worry about consumer prices going down. If consumer prices actually went down, that would be a good thing.
I feel like this could go on for a very long time. Ron, I want to ask you about a specific metric that a lot of people have been talking about as one metric of why, whether it's a bubble or not, what's going on in the equity market is worrisome, and that is record amounts of debt being taken out by corporate America to buy back their own stock, that it's basically a leverage-fueled rally, even if it's not a Fed-fueled rally. What do you make of that?
Well, I wouldn't go so far as to say that. I mean, banks I should say corporations have recapitalized their balance sheets and are the cleanest we've seen since the 1950s. We've seen about $2.5 trillion in the reduction of outstanding shares and payouts in dividends. And corporations get rather large tax advantages for borrowing that money, even at exceedingly low interest rates. So it's not the type of levered market that we've seen in the past. It doesn't have the classic fundamental or technical fingerprints of a bubble. Certainly not at 15 times forward earnings. And so I don't see what everybody else sees.
Very quickly,
you were blindsided by the housing bubble in the 2008 crisis. You were just as sanguine in 07 as you are now.
I absolutely
you still don't understand the big picture.
Bill, just to clarify this once and for all, would you just please acknowledge that from 2005 and 2007 I was warning about mortgages that were a bit frothy and a very, very frothy housing market.
Alan Greenspan. Well, that doesn't constitute a warning.
I could acknowledge that and vouch for that. Yes, I can.
Friday afternoon, you guys should go get a beer.
We got to go. Thanks, guys. Appreciate it very much.